Dear friends, you'll watch the American empire collapse this fall, and I mean watch, not read about later, not find out in a history book. Watch in public data, on dates you can put on a calendar right now. On June 2nd, the European Central Bank published a report confirming that gold has passed U.S. Treasury bonds as the largest reserve asset held by the world's central banks. First time since 1996, gold is now 27% of global official reserves. Treasuries are 22%. Foreign central banks hold roughly $4.5 trillion in gold against about $3.5 trillion in American government debt. Meanwhile, $9.2 trillion of our national debt matured in a single fiscal year, roughly a quarter of everything we owe, and had to be refinanced at rates that have doubled since 2021. Every quarter point costs another $95 billion a year. And the World Gold Council surveyed 76 central banks. 74% expect to hold fewer dollars in 5 years. They are not hiding it. They published it, so sit down, because I am going to show you exactly where to watch this happen. Gold just passed us. Treasuries is the world's largest reserve asset for the first time since 1996. Let me start with the single most consequential financial development of this year, and I want you to notice how little coverage it received, because that tells you something too. On June 2, 2026, the European Central Bank published its annual report on international reserves. And buried in that report was a finding that should have been front-page news in every country on Earth. Gold has overtaken U.S. Treasury bonds as the largest reserve asset held by the world's central banks. The numbers, as of the end of 2025, gold accounted for 27% of global official foreign reserves. U.S. Treasuries accounted for 22%. The euro accounted for 15%. In dollar terms, foreign central banks now hold roughly $4.5 trillion worth of gold against approximately $3.5 trillion in U.S. government bonds. The last time gold sat above treasuries in the world's reserve accounts was 1996. Bill Clinton was in his first term. The euro did not exist yet. That is how far back you have to go to find the last time the world's central bankers held more metal than American promises. Now, I want to give you the honest counter-argument first, because I think it makes the case stronger rather than weaker. And because I do not want you sharing this and getting embarrassed by somebody who read the footnotes. The ECB itself pointed out that gold's share topped treasuries mainly because of what economists call valuation effects. Gold prices rose about 60% in 2025 and about 30% in 2024. When the price of an asset you already hold goes up 60%, its share of your portfolio increases mechanically, without you buying a single additional ounce. The ECB said so explicitly. Those gains mechanically increase the share of gold in total official foreign reserves. So a fair-minded person has to say clearly that this crossover was driven substantially by price, not purely by central banks dumping treasuries and stacking bullion. But here is why that caveat does not let anybody off the hook. And this is the part one wants you to really sit with. Why did gold rise 60% in a single year? Assets do not appreciate 60% because of nothing. Gold pays no interest. It generates no earnings. It has no cash flow. There is exactly one reason gold rises that dramatically, and it is that large, sophisticated buyers with enormous balance sheets decided they wanted something that carries no counterparty risk, cannot be frozen, cannot be sanctioned, and does not depend on the fiscal behavior of any government. The demand that drove the price is the same phenomenon as the shift in the reserve share. They are not two separate stories. They are one story told twice, and the buying is documented independently of the price. Central banks have purchased an average of about 1,000 tons of gold per year over the past 4 years. That is roughly double the 500-ton average of the preceding decade. The People's Bank of China has added to its gold reserves for 20 consecutive months. China's gold holdings now stand at roughly 2,322 tons, up from about 1,658 tons in 2015, an increase of about 57%. Over that same stretch, China reduced its U.S. Treasury holdings substantially, from roughly $901.7 billion in September of 2022 to about $730.7 billion by mid-2025, a decline of roughly 19% in under 3 years. That is not a valuation effect. That is a decision, executed month after month for years. Now let me explain why reserve managers are doing this, because the reason is specific and it dates to a particular moment. After 2022, when Russian central bank reserves held abroad were frozen, every reserve manager on Earth had to sit down and ask a question they had never seriously asked before. What exactly do I own when I own a U.S. Treasury bond, and under what circumstances can somebody else prevent me from using it? The answer they arrived at is that a Treasury bond is a claim on the United States government, held within a financial system the United States controls, and that claim can be immobilized by policy decisions made in Washington. Gold sitting in your own vault in your own country cannot be. It carries no credit risk, no counterparty risk, and it cannot be sanctioned. The World Gold Council captured the resulting mindset shift in its 2026 survey. 84% of responding central banks now describe gold as a long-term store of value. And here is the number that I find most revealing. Only 46% cited historical legacy as a reason for holding it, down from 62% the year before. Think about what that shift means. A year ago, a substantial share of central bankers held gold essentially out of tradition, because it had always been in the vault. Now they hold it on purpose, for a stated strategic reason. Gold went from an heirloom to a decision. That is the change, not the price. The reasoning. And there is one more detail in that survey worth your attention, because it speaks to durability. Nearly half of the responding central banks said they expect to increase their own gold holdings over the coming year, and the World Gold Council noted that this was the highest proportion recorded since the survey began. Not the highest in a few years, the highest ever measured. When you combine that with the fact that central banks have been buying roughly 1,000 tons annually for 4 straight years against a preceding decade average of about 500, you are not looking at a reaction to one bad headline. You are looking at a sustained, multi-year reallocation by the most conservative, slowest-moving institutions in global finance. Central banks do not chase trends. They are structurally incapable of moving quickly. They answer to political authorities, and they are penalized far more for looking reckless than for looking slow. When institutions like that all move in the same direction for 4 consecutive years, it is because they have collectively concluded something about the world, not because they got excited about a chart. $9.2 trillion of our debt came due in a single year and had to be repriced. Now let me show you the other side of that ledger, because while the world was buying gold, we were doing something on our end that made their decision look increasingly reasonable. Here is a concept most Americans have never encountered, and that determines the entire trajectory of this country's finances. It is called the maturity wall, or the refinancing wall. Our national debt is not one loan. It is millions of individual securities with different maturities. 4-week bills, 13-week bills, 2-year notes, 5-year notes, 10-year notes, 30-year bonds. Each one comes due on a specific date, and when it comes due, the government does not pay it off, because there is no surplus to pay it off with. It issues a new security to replace it. That is called rolling the debt, and it is entirely normal. Every large borrower does it. The problem is what happens when you roll debt into a higher interest rate environment. In fiscal year 2025, approximately $9.2 trillion of outstanding federal debt matured and had to be refinanced. $9.2 trillion, that is roughly 25% of the entire national debt, coming due and being reissued in a single 12-month period. Now, here is why that matters so enormously right now, rather than 5 years ago. A great deal of that maturing debt was originally issued during the near-zero interest rate era, when the Treasury could borrow for almost nothing, and it was replaced with new debt issued at today's rates. The weighted average interest rate on the federal debt has roughly doubled, from about 1.61% in 2021 to about 3.36% in 2025. Doubled on $38 trillion. And here is the sensitivity that should frighten every taxpayer in this country. At that scale of debt, every additional quarter of a percentage point in the average rate adds roughly $95 billion per year in interest costs. $95 billion from a quarter point, for scale. $95 billion is more than the entire annual budget of most federal departments. A single quarter point move on the average rate costs more than the federal government spends on the Department of Transportation. And nobody voted on it. It just happens, automatically, as old cheap debt matures and gets replaced with new expensive debt. This is the mechanism that produces the number people quote without understanding. Interest on the federal debt crossing $1 trillion a year did not happen, because Congress passed an interest spending bill. It happened because trillions of dollars of 1.5% debt matured and came back as 4.5% debt. And the process is not finished. It is roughly a quarter done per year, mechanically, on a schedule, whether anyone in Washington does anything or not. Now think about what that does to the federal budget over the next several years. Interest is not discretionary. You cannot decide to fund less of it. It is not a program that can be reformed, means-tested, or block-granted to the states. The coupon payments go out on the dates printed on the securities, or the United States defaults. So as interest consumes more of the budget, everything that is discretionary gets squeezed. infrastructure, research, education, environmental protection, veteran services, the whole list. And here is the part that connects it back to the first section. When the interest cost of your debt rises, you have to issue even more debt to cover it, which increases supply, which, all else equal, requires higher yields to attract buyers, which raises your interest cost further. That loop has a name in the sovereign debt literature, and it is not a friendly one. Now, I want to be careful and honest with you here because I do not want to oversell this. The United States is not Argentina, and it is not Greece. We borrow in our own currency, which we also issue, which means we cannot be forced into a technical default by an inability to obtain dollars. That is a genuine and enormous structural advantage, and anyone who ignores it is not being straight with you. But that advantage does not eliminate the consequence. It changes the form of the consequence. A country that borrows in its own currency does not default in the conventional sense. It inflates, or it lets the currency depreciate, or it financially represses savers by holding rates below inflation, which is to say the bill still gets paid. It just gets paid by whoever holds the currency rather than by whoever holds the bonds. And that is you. If you have savings in dollars, a pension denominated in dollars, or a fixed income stream in dollars, you are the one who pays. Watch the auctions, because that is where the world votes on America twice a week. All right, now I want to teach you something that will let you watch this yourself, in real time, without waiting for anybody on television to interpret it for you. Because the most important recurring vote on the credibility of the United States government does not happen in November. It happens dozens of times a year in a Treasury auction, and the results are published publicly within minutes. Here is how a Treasury auction works. The government announces it will sell a certain amount of a certain security. Buyers submit bids. The Treasury accepts bids starting from the lowest yield and works up until the entire offering is sold, and then it publishes the results. There are 3 numbers in those results that tell you what the world actually thinks, as opposed to what anyone says. The first is the bid-to-cover ratio. That is total bids received divided by the amount actually sold. If Treasury sells $25 billion and receives $66 billion in bids, the bid to cover is about 2.66. Higher is better. It means more demand than supply. The Government Accountability Office, in its March 2026 audit of federal debt management, found that average bid-to-cover ratios have generally been above 2, and often closer to 3 across security types, meaning 2 to 3 times more bids than securities offered. The second number is primary dealer absorption, and this one is the real tell. Primary dealers are a small group of large banks that are contractually obligated to bid at every Treasury auction. They are the buyer of last resort, so when a large share of an auction ends up with primary dealers, it means genuine end investors, pension funds, foreign central banks, insurance companies, did not show up in sufficient size and the dealers had to eat the difference to prevent a failed auction. Lower dealer absorption is healthier. The third is the auction tail, which is the gap between the yield the market expected and the yield the auction actually cleared at. A large tail means Treasury had to pay more than anticipated to get the debt sold. Now let me show you what those 3 numbers looked like in a genuinely bad week, because it happened this year. In late March of 2026, the Treasury held 3 major auctions, $69 billion of 2-year notes, $70 billion of 5-year notes, and $44 billion of 7-year notes. The Committee for a Responsible Federal Budget analyzed all 3, and concluded every one of them went poorly across all 3 metrics. The 2-year auction was particularly bad. The bid to cover came in at 2.44, well below normal, and primary dealers absorbed nearly a quarter of the entire auction, against a prior 6-month average of about 11%, so dealer absorption more than doubled. That is the market telling you that real end investors stepped back and the obligated buyers had to fill the hole. The 7-year auction showed some improvement in bid to cover, but produced an auction tail of 0.8 of a basis point against an average of 0.3, meaning Treasury paid meaningfully more than expected. What drove it? CRFB pointed to rising oil prices following the conflict with Iran, which fed into inflation expectations, which pushed markets to price tighter monetary policy and higher short-term rates. And critically, investors began demanding a higher term premium, which is the extra compensation they require for the risk of holding longer-dated securities in an uncertain environment. Term premium is the number to watch. It is functionally the risk premium the world charges the United States for the privilege of lending to it over long horizons. When it rises, the market is not saying it thinks we will fail to pay. It is saying it wants more compensation for the uncertainty around how we will pay. Now, in fairness, and I insist on giving you the full picture, the April auctions recovered. The benchmark 10-year bid to cover rose to 2.45 in early April, up from 2.28 in March, and analysts noted a tentative return of foreign participation. And across the full run of auction data through 2025 and 2026, the broader trend in bid to cover has been closer to stable than to systematically declining. So, the honest read is this: we are not watching a collapse in demand for Treasury securities, we are watching demand become conditional and price-sensitive in a way it was not a decade ago. The world will still lend to us. It has begun negotiating harder about the terms, and that shift is precisely how the decline of a reserve currency actually looks from the inside. Not a dramatic failed auction, a slow quarter-by-quarter renegotiation of the price of American credibility. Here is how to watch it yourself, and I want you to actually do this once. Go to treasurydirect.gov and look at the auction results page. Pick any recent 10-year or 30-year auction. Find the bid-to-cover ratio, which is printed right there. Find the allotment percentages by bidder category. Look at the indirect bidders, which is the category that includes foreign central banks. Then look at the same auction from a year ago and compare. It takes 15 minutes, and it will teach you more about the actual position of the United States in the world than a year of cable news. 74% of central banks said in writing they expect to hold fewer dollars. Here is something that I find genuinely remarkable, and it is that we do not have to speculate about what the world's monetary authorities intend to do. They filled out a survey and published the answers. The World Gold Council conducts an annual central bank gold reserve survey. The 2026 edition gathered responses from 76 central banks. These are not commentators or analysts. These are the institutions that actually hold the reserves, stating their own intentions on the record. 89% of them expect global gold reserves to increase over the next 12 months. 74% anticipate that the share of US dollar holdings in global reserves will decline over the next 5 years. Nearly half expect to increase their own gold holdings over the coming year, which the survey noted was the highest proportion recorded since the survey began. Let me say the middle number again slowly, because it is the one that matters. 3/4 of the world's central banks, surveyed, on the record, expect to hold a smaller share of dollars 5 years from now. That is not a prediction by a pundit. That is a stated expectation by the people who make the decision. When 3/4 of the participants in a market tell you they plan to reduce their allocation to an asset, that is about as clear a forward signal as financial markets ever produce. Now again, let me be precise about what this does and does not mean, because precision is what separates useful analysis from panic. It does not mean the dollar loses reserve currency status in 5 years. It will not. There is no viable replacement. The euro has a currency without a unified fiscal authority. The Chinese yuan is not freely convertible and operates under capital controls, which disqualifies it for most reserve purposes. Gold does not scale as a transactional medium for global trade. Nobody is prepared to settle a container ship of electronics in bullion. What it means is dilution, a gradual reduction in the dollar's share, spread across many reserve managers, over many years, in a direction that is essentially unanimous. And dilution matters because of a specific privilege it erodes. Reserve currency status is the reason the United States can run persistent trade deficits and persistent fiscal deficits at the same time, without the currency crisis that would punish any other country doing the same thing. Foreign nations sell us goods, receive dollars, and recycle those dollars back into U.S. Treasury securities, which funds our government. It is a circular system, and it works as long as the rest of the world wants to hold dollars at the current scale. When they want to hold fewer, the recycling weakens, which means fewer buyers for Treasury securities at any given yield, which means the Treasury has to offer higher yields to clear its auctions, which raises borrowing costs for the government, and because Treasury yields are the benchmark for essentially every other interest rate in the economy, it raises your mortgage rate, your car loan rate, your credit card rate, and the rate on every corporate bond that funds the company you work for. That chain is real, it is mechanical, and virtually nobody explains it to ordinary Americans in those terms. And here is the piece of evidence that the survey is already showing up in prices. The US dollar index fell 10.1% in 2025. That was the steepest annual decline in 3 decades. A 10% currency decline is not an abstraction. It means every imported good costs about 10% more in dollar terms before a single tariff is applied.
Electronics, pharmaceuticals,
auto parts, coffee, produce in the off-season. It means overseas travel costs more. And it means the purchasing power of a dollar-denominated pension, measured against goods produced anywhere else on Earth, declined by 1/10 in 12 months. You felt that at the grocery store and nobody told you the currency was part of the reason. The calendar this fall will show you exactly where this stands, and you can read it yourself. So let me be concrete about the title of this video, because I want to be straight with you about what I am actually claiming. I am not telling you the United States ceases to exist this fall. That is not what happens, and anyone who tells you otherwise is selling something. Nations do not vanish. Empires in decline persist for a long time, and life inside them goes on, which is precisely why decline is so hard to see from the inside. What I am telling you is that this fall you can watch the mechanism operate on specific dates in public data if you know where to look, and most people never look, which is why they will find out later from a headline instead of earlier from a spreadsheet. So here is your calendar, and I want you to actually put these on it. Treasury auction results, published continuously. Treasury conducted 444 auctions in fiscal year 2025, up from 271 in fiscal 2014, which by itself tells you how much more frequently this government now goes to market. Every result is posted at treasurydirect.gov within minutes. Watch the 10-year and 30-year auctions specifically, because the long end is where the stress shows up first and where the variability has been greatest. Track 3 things: bid to cover, primary dealer absorption, and the indirect bidder share, which is your proxy for foreign official demand. The quarterly refunding announcement. Treasury publishes this in early February, May, August, and November. It states how much debt Treasury intends to issue, in what maturities over the coming quarter. This is the single most underrated economic document published in the United States. When Treasury shifts issuance towards shorter maturities, that is a signal it is worried about demand at the long end, because short bills are always easier to sell. Watch the November announcement carefully. The Treasury International Capital Report, called TIS-EC, published monthly with about a 2-month lag. It shows foreign holdings of U.S. securities by country. This is where you watch whether China's holdings continue their decline from roughly $900 billion in 2022 toward and below the $700 billion range, and whether Japan, which has been holding around $1.15 trillion, continues to be the offsetting buyer. The World Gold Council's quarterly gold demand trends report, which tracks central bank purchases. Central bank buying is projected at roughly 850 tons for 2026, following 4 years averaging about 1,000 tons annually. Watch whether that pace holds Federal Reserve meetings in September, October, and December, and specifically what the statement says about the balance sheet, because the Fed is itself one of the largest holders of Treasury securities, and its decisions about reinvestment directly affect how much debt the private market has to absorb. Credit rating agency reviews. All 3 major agencies have already moved the United States off AAA. Watch for outlook changes, which typically precede rating changes by 6 to 18 months. And the ECB's international reserves reporting and the IMF's COFR data, which is where the reserve share numbers we have been discussing get published and revised. Now here is the honest interpretive framework I would ask you to apply to all of it, because I think how you watch matters as much as what you watch. Do not look for a single dramatic event. That is not how this works. And expecting one will cause you to dismiss the real evidence when it appears. There will be no mourning when a Treasury auction fails outright and the system stops. What there will be is a long sequence of small deteriorations, a bid to cover slightly lower than the 6-month average, dealer absorption a few points higher, an auction tail a fraction of a basis point wider, foreign holdings down another 20 billion, gold up another 100 tons. Any one of those is noise. All of them together, sustained over quarters, is a trend. And the trend is the thing. That is what decline actually looks like from the inside, not a bang. A slow, quarterly, documented renegotiation of terms, conducted in public by institutions with no incentive to announce what they are doing, in reports that almost nobody reads. You now know where the reports are. That puts you ahead of essentially everyone you know. Britain learned exactly what this feels like in 1976. And the parallel is uncomfortable. I want to take you back 50 years now, because there is a historical episode that shows precisely how this ends for a country that was, within living memory, the dominant power on Earth. And almost no American has ever heard of it. In 1976, the United Kingdom effectively ran out of buyers for its own government debt. Set the stage. Britain in the mid-70s was not a poor country. It was a developed industrial democracy with a sophisticated financial center, a permanent seat on the UN Security Council, and a currency that had been the world's reserve currency within the lifetimes of most people then alive. Sterling had been the dollar of the 19th century. London had been the financial capital of the planet. And in the space of a few months in 1976, the British government discovered it could not fund itself. The mechanism was ordinary, and it is worth understanding because it is the mechanism we have been discussing. Inflation was high. Government deficits were large, confidence in the currency was eroding, And investors in gilts, which is what the British call their government bonds, began simply declining to buy at the prices the government wanted to sell at. The financial press at the time called it a buyer's strike. Nobody announced it. There was no press conference. Investors just stopped showing up. The pound fell hard against the dollar, and as it fell, the situation became self-reinforcing, because every decline made holding sterling assets less attractive, which produced more selling, which produced more decline. In September of 1976, the Chancellor of the Exchequer, Deanie Healey, was on his way to Heathrow Airport to fly to a Commonwealth Finance Ministers' conference, and the currency was falling so fast that he turned around at the airport and went back to deal with the crisis. A sitting finance minister of a G7 nation could not leave the country because his currency was in free fall. Britain then did something that would have been unimaginable a generation earlier. It applied to the International Monetary Fund for a loan. Roughly $3.9 billion, which at the time was the largest loan the IMF had ever extended to anyone. The country that had run a quarter of the world's landmass went to the international lender of last resort, the institution that existed to rescue developing economies in distress, and asked for help. And the IMF attached conditions, as it always does: spending cuts, fiscal targets, oversight. The British government had to accept externally imposed constraints on its own budget in order to obtain the money. Now, I want to be clear about the aftermath because the story is not as apocalyptic as it sounds, and the honest version is more useful to you. Britain did not cease to exist. The economy recovered over the following decade. Sterling stabilized. In fact, the country ultimately drew down less of the IMF facility than it had arranged and repaid ahead of schedule. Life went on, but something permanent happened in 1976 anyway, and it is the thing I want you to notice. Before that year, Britain still thought of itself, and was still treated by others as a first-rank power whose finances were beyond question. After it, that was over. The psychological transition was complete. The country reorganized itself around a different and smaller self-understanding, and it has operated that way ever since. Historians generally treat 1976 as the moment the post-war British illusion finally broke. And here is the parallel I want you to sit with, along with the crucial difference. The mechanism that broke Britain was persistent deficits, elevated inflation, a declining currency, and creditors who gradually decided they wanted better terms. Look at what we have been discussing. Persistent deficits, elevated inflation, a dollar that fell 10.1% in 2025, the steepest drop in 3 decades. Creditors demanding higher term premium and in 74% of surveyed cases, planning to hold fewer of our assets in 5 years. The ingredient list is the same, now the difference. And it is enormous, and I will not minimize it. Britain in 1976 had substantial debt denominated in foreign currency, and it needed dollars it could not print. That is what forced it to the IMF. The United States borrows in dollars and issues dollars. There is no IMF for us, and we will never need one, because we cannot be forced to obtain a currency we manufacture. So we do not get a 1976. We get something different, and arguably worse in one specific respect, because there is no external creditor who can force a reckoning. There is no forcing event. Britain got a crisis that compelled action within months. We get a slow grind that can continue for decades, adjusting through inflation and a depreciating currency rather than through a dramatic moment that concentrates the political mind. Britain got a heart attack. We are getting high blood pressure. The heart attack is more frightening. The high blood pressure kills more people. Precisely because nothing ever happens on any particular Tuesday that makes anyone change course. Pay attention to who owns the debt now, because the buyer has changed, and that changes everything. Now let me explain something technical that I think is the single most undercovered development in American finance, and once you understand it, you will see why the coming years look different from the past 20. It is not just how much debt we owe, it is who holds it, and what kind of buyer they are. For roughly the last 30 years, an enormous share of U.S. Treasury securities was held by foreign official institutions, central banks, sovereign wealth funds, government-affiliated entities in China, Japan, the Gulf states, and elsewhere. Those buyers had a specific and very valuable characteristic. They were largely price-insensitive. Here is what that means. A foreign central bank accumulating dollar reserves because it runs a trade surplus with the United States is not buying treasuries to maximize investment return. It is buying them because it needs somewhere to put dollars, because it wants to manage its own exchange rate, and because treasuries are the deepest and most liquid dollar asset in existence. Whether the yield is 2% or 4% is largely beside the point. The purchase is a byproduct of trade and currency policy, not an investment decision. A price-insensitive buyer is the best customer any borrower can possibly have. They show up regardless. They do not negotiate. They do not demand a premium when your fiscal outlook deteriorates. For decades, that steady official bid was the invisible foundation of American borrowing costs, and it is a very large part of why the United States was able to run deficits that would have punished any other country. That buyer is stepping back. China's holdings declined from roughly $901.7 billion in September of 2022 to about $730.7 billion by the middle of 2025, a reduction of roughly 19% in under 3 years. Japan has held roughly steady around $1.15 trillion, but a single stable buyer cannot offset a broad structural shift. And across the surveyed universe, 74% of central banks say they expect a smaller dollar share within 5 years. So who is buying instead? Increasingly, domestic private investors, money market funds, hedge funds, banks, pension funds, insurance companies. American households buying Treasury bills directly, which incidentally is why retail participation and Treasury direct account openings have surged in recent years. And every one of those buyers is intensely price sensitive. A hedge fund buys a 30-year bond because it believes it will make money on that trade. A money market fund buys a bill because the yield beats its alternatives that morning. A pension fund buys duration because it needs to match a liability at an acceptable spread. Every single one of them will walk away if the price is not right, and every one of them will demand more compensation the moment the fiscal picture looks worse. That is the transition. We are replacing a customer who bought regardless of price with customers who buy only at the right price. And there is no version of that swap where the borrower pays less. This is exactly what term premium measures, and it is why term premium has been rising. It is the market's way of pricing the fact that the buyer base has changed character. There is a second consequence that gets even less attention. Price-sensitive buyers are also fickle buyers. A foreign central bank does not panic sell during a market disruption because it is not managing to a return target and it is not subject to margin calls. A leveraged fund is, which means that as the ownership base shifts toward private and leveraged holders, the Treasury market becomes structurally more prone to sudden dislocations during periods of stress. We have already seen previews of this in episodes where the world's supposedly safest market briefly stopped functioning smoothly and required official intervention to restore order. And you can watch this shift yourself, which is the point. The Treasury International Capital Report, published monthly, breaks foreign holdings out by country. The auction results published at Treasury Direct break every auction into 3 bidder categories: direct bidders, indirect bidders, and primary dealers. Indirect bidders is the category that captures most foreign official participation. When that share declines across a run of auctions and primary dealer absorption rises to compensate, that is the transition happening in front of you, one auction at a time. Also worth watching, and this comes straight out of the GAO's March 2026 audit, the weighted average maturity of the marketable debt. When Treasury shortens the average maturity of its borrowing, it means Treasury is finding it easier to sell short paper than long paper. Short paper is cheaper today, and it is also a decision to reprice that borrowing again very soon. A country steadily shortening the maturity of its debt is a country choosing to roll the dice on future interest rates more frequently, which is exactly what a borrower does when the long end has become expensive. None of this is hidden. All of it is published, and essentially nobody reads it, which is why the people who do read it have such an enormous informational advantage over everyone who waits for the news to explain it to them. Here is what all of this actually does to a household budget. Let me bring this all the way down to your kitchen table now. Because macroeconomics is worthless if it does not translate into decisions, and I want to be very concrete. Here is how each thread I have described reaches you personally. Rising Treasury yields raise your borrowing costs. The 10-year Treasury is the benchmark for the 30-year mortgage. When term premium rises because investors demand more compensation for lending to the United States over long horizons, mortgage rates rise, and they rise regardless of what the Federal Reserve does with short-term rates. Many people do not know that. They watch the Fed and expect their mortgage rate to follow, and then are confused when the Fed cuts and mortgage rates do not move. The long end is a different market with different buyers, and increasingly those buyers are asking for more. A declining dollar raises your cost of living. 10.1% in a single year, the steepest in 3 decades. Every imported good reprices upward in dollar terms. And the United States imports pharmaceuticals, electronics, auto parts, machinery, and a substantial share of its produce during the off-season. Rising interest expense at the federal level squeezes everything else in the budget over time. Interest is non-negotiable, So the pressure lands on the discretionary side, and eventually on the programs that older Americans depend on, not through dramatic cuts but through eligibility tightening, formula adjustments, and benefit growth that quietly lags actual costs. And the currency debasement channel is the one nobody explains. When a government borrows in its own currency and the debt load becomes unmanageable relative to the economy, the historical resolution is almost never an explicit default. It is inflation and financial repression, meaning nominal interest rates held below the inflation rate. Under financial repression, a saver holding cash and bonds loses purchasing power steadily and slowly, year after year, while the debt is quietly inflated down relative to the size of the economy. It is a transfer from savers to the borrower, and the largest borrower is the government. So what do you actually do? Let me be practical, and let me be clear that I am not your financial advisor, and this is general information, not personalized advice. Take this to a fee-only fiduciary who is legally obligated to act in your interest and have them run your actual situation. First, understand that cash is the asset with guaranteed loss in this environment. Not high risk, guaranteed. If your money earns 0.5% while prices rise 4%, you lose 3.5% of purchasing power every year with certainty. That does not mean hold no cash. Emergency reserves are essential. It means do not hold cash that is not doing a job, and make sure the cash you do hold is earning something. Treasury bills, money market funds, and high-yield savings accounts at FDIC-insured institutions have all been paying multiples of what a traditional savings account pays. Moving an emergency fund is a 20-minute task that can be worth hundreds or thousands of dollars a year. Second, look at instruments explicitly indexed to inflation. Treasury inflation-protected securities and Series 1 savings bonds are both designed for exactly the scenario we are discussing, where the risk is purchasing power erosion rather than default. They are not exciting. They are appropriate. Third, fixed-rate debt behaves very differently from variable-rate debt in an inflationary period. A fixed-rate mortgage taken at a low rate is, in real terms, an asset that gets easier to service as wages and prices rise. Variable-rate debt is the opposite and gets more expensive automatically. So the priority order is straightforward. Pay down variable-rate debt aggressively and be much slower to prepay low fixed-rate debt. Fourth, diversify what your income and assets are denominated in. That does not require anything exotic. Broad international equity exposure inside a retirement account is denominated partly in other currencies and provides a partial hedge against dollar depreciation. Many American households hold essentially 100% domestic exposure without ever having made that as a decision. Fifth, if you are drawing a fixed income stream, model it honestly. Take your actual pension or annuity, apply 4% annual inflation, and see what its purchasing power looks like in 10 and 20 years. That exercise is unpleasant, and it is the single most clarifying thing a retiree can do, because it turns an abstraction into a number you can plan around while there is still time. And sixth, and this one is not financial at all, the most reliable hedge against systemic decline that has ever existed is a functioning local community and a set of skills that people will always need. That has been true in every declining empire in recorded history. The households that came through were the ones embedded in networks that could share labor, tools, food, and information. That is not a portfolio allocation, and you cannot buy it. You build it in advance by being the kind of neighbor other people want to have. Before you close this video, understand what I am and am not saying. I want to end with something that I think matters more than any number I have given you, because I have watched a lot of people take information like this and do the wrong thing with it. Everything in this video is documented. The ECB report on June 2nd. The World Gold Council survey of 76 central banks. The Committee for a Responsible Federal Budget's auction analysis. The GAO's March 2026 audit of federal debt management. Treasury's own published auction results. You can verify every single figure, and I encourage you to, because you should never take a stranger's word on the internet about your money, including mine. But here is what those documents do not say. They do not say the United States collapses this fall. They do not say the dollar becomes worthless. They do not say you should liquidate your retirement account and put it in metal. Anybody who takes this data and arrives at those conclusions is either not reading carefully or is selling you something, and there is an enormous industry built on selling frightened people expensive products. What the documents say is more measured and honestly more sobering, because it does not resolve. They say the world's central banks are quietly, methodically, and by their own stated intention, reducing their dependence on American financial assets. They say the cost of servicing our national debt is rising mechanically as cheap debt matures and expensive debt replaces it, at a pace of roughly a quarter of the total per year, with every quarter point on the average rate costing another $95 billion annually. They say the market is beginning to charge us a higher premium for long-horizon lending. They say the dollar fell 10.1% in a year, and they say 3/4 of the world's reserve managers expect to hold fewer dollars in 5 years. None of those is a catastrophe by itself. Every one of them is a direction. And directions sustained long enough become destinations. The reason I called this video what I called it is not that a building falls down in October. It is that this fall, for the first time, an ordinary person with an internet connection and 15 minutes can watch the machinery of imperial decline operate in real time, in public data, on a published schedule. That has never been true before. Reserve currency transitions used to be visible only to historians. This one is being documented quarterly, in English on government websites for free. That is a genuine gift, and almost nobody is using it. So use it. Look up one Treasury auction result this week. Read the November refunding announcement when it comes out. Check the TSE report once a quarter. It will take you an hour a quarter, and you will understand the actual position of this country better than most people who talk about it professionally. And then act on what is in front of you, rather than what might happen. Move your savings somewhere that pays. Pay down the variable rate debt. Look at inflation-indexed instruments. Model your fixed income against real inflation. Diversify what your assets are denominated in. Talk to a fiduciary. And build the local relationships that have carried households through every one of these transitions in recorded history. Because here is the thing about watching an empire decline from the inside. You do not get to stop it from your kitchen table. Nobody does. But you absolutely get to decide whether it happens to you or around you. And the difference between those two outcomes is preparation that begins before it is obvious that preparation was needed. That moment is right now. Take care of yourselves out there.